Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Yeah, let's get into it.
So, Wall Street is totally terrified right now, like completely freaking out because this massive rumor is just spreading like wildfire.
Oh, absolutely. It's everywhere.
Right. The headline you were probably seeing on, every financial blog is that the biggest institutional investors, like the billionaires, the big money, they've just secretly abandoned artificial intelligence and totally dumped their tech stocks.
Yeah, the doom and gloom narrative.
Exactly. People are panicking, assuming the AI bubble has just violently burst, right?
Yeah.
And that the smart money is sprinting for the exits. But we took a massive stack of recent SEC filings, historical market data, and quarterly reports to see if that is actually true. And based on the data, the reality is way more complex than just some clickbait headline.
What's fascinating here is that when you strip away the panic and just look at the actual mathematical footprint of these trades, the market reality is entirely different.
Right.
The big players are absolutely not fleeing AI. They haven't lost faith in the technology at all. Instead, we're seeing this massive evolution of market psychology.
But they aren't running away.
No, not at all. They are just getting incredibly ruthless and picky about exactly how they deploy their capital.
Okay, and to really grasp what they are doing, we have to look closely at the underlying mechanism of where this data even comes from. According to recent analysis, all of this panic is stemming from something called a 13F filing.
Yes, the infamous 13F.
Right. And for a beginner investor looking at the American markets, this sounds like a bunch of boring financial jargon. But it is simply a mandatory disclosure. I mean, any institutional investment manager controlling over $100 million in qualifying assets has to file this report with the SEC. It's literally a legal requirement to show the public what they own.
And, these reports are required every single quarter.
The specific data setting off all the alarm bells today is from the second quarter of 2026, which officially ended on June 30th.
Right, end of the quarter.
Exactly. And the legal deadline for these massive hedge funds to submit their homework to the SEC was August 14th.
Okay, let's unpack this because to a retail investor, getting access to a billionaire's 13F sounds like, I don't know, finding a cheat code to the stock market.
Oh, totally. People think it's the Holy Grail.
Yeah, you feel like you get to look at the answers to the test. But I think about it with a more everyday analogy. Looking at a 13F filing is basically like walking into a master chef's kitchen pantry on one specific day, exactly June 30th.
Just a snapshot.
Exactly. You open the door and you see the exact ingredients sitting on the shelves on that specific afternoon. But you have zero context. I mean, you have no idea if they bought the flour back in April or on the morning of June 29th.
Right, or what price they paid. Right. You don't know if they bought it on sale or paid a massive premium. And most importantly, you have no idea if they have a secret freezer out in the garage holding completely different ingredients that they're actually planning to cook with.
And that secret freezer is the crucial missing piece that retail investors always overlook.
Always.
Because what a 13F filing legally hides is arguably more powerful than what it reveals. It does not require funds to disclose short positions, which, is when they are actively betting against a stock.
So they could be betting against the very things they hold.
Exactly. Plus, it completely hides over-the-counter swaps, foreign exchange trades, private non-listed assets, and most complex derivatives. It is literally just a localized snapshot of long positions in U.S.-listed stocks at the closing bell on June 30th.
Wow.
Furthermore, because the SEC gives these funds up to 45 days after the quarter ends to publish this list, you are staring at a delayed echo of the past. You are not looking at a real-time trading log.
Okay, so knowing that this is just a delayed, incomplete snapshot, I have to ask why this sudden, overwhelming panic about an AI sell-off. I mean, I read a very specific rumor on some financial forums that Bridgewater, which is one of those powerful hedge funds on Earth, that they liquidated 90% of all their AI stocks.
Yeah, that rumor got a lot of traction.
Right. And if I'm holding tech stocks in my retirement account, reading that Bridgewater just dumped everything sounds like a massive red flag.
It sounds alarming, sure, but it is a fundamental misinterpretation of the data.
Okay.
Let's correct the record by looking at the exact share counts. Did Bridgewater sell a significant amount of tech? Yes, they did. They cleared out their secondary positions. They dumped 92% of their holdings in Micron, 96% of their TSMC position, and 90% of Marvell.
Okay.
But they absolutely did not dump the core of the AI revolution. Their anchor position in NVIDIA was barely touched. They only trimmed it by about 17%.
Wait, really? Only 17%.
Yeah, and they reduced Broadcom by 28% and Amazon by 53%.
Yeah. Let's pause on that. Trimming a position by 17% is drastically different from a 90% liquidation. That just sounds like standard portfolio management.
That is precisely what it is. I mean, even after that 17% trim, NVIDIA remains Bridgewater's third largest individual stock holding globally.
Wow, third largest.
Yeah. We are talking about roughly $774 million anchored in NVIDIA, making up 3.2% of their entire multi-billion-dollar portfolio. Broadcom and Amazon also remain massive core pillars for them, sitting at around 2% of their total assets each.
So they're still heavily invested.
Very heavily. Calling Bridgewater bearish on AI completely ignores the fact that they are still holding hundreds of millions of dollars of the most important AI hardware companies in the world.
Yeah, taking some profits off the table after a massive bull run is not the same as abandoning the company. But Bridgewater is just one fund. If I'm looking at the rest of Wall Street, are we seeing that same subtle trimming, or are other funds actually panicking and running for the exits?
Well, looking at a comprehensive data set of over 6,300 financial institutions,
Right.
the narrative of a market-wide AI exodus completely falls apart.
It's just not there.
Not at all. There was no 48 or 49% mass liquidation across the board. If you look at the Magnificent Seven, the dominant American tech giants, the institutional moves were remarkably balanced.
Really?
Yeah. About 42% of institutions actually increased their positions or opened new ones, while 44% decreased their holdings.
So the market was essentially split right down the middle.
Completely split. And when you isolate semiconductors, the physical chips that make AI possible, the data is even more bullish.
Oh, wow.
Yeah, 48% of these institutions were net buyers of semiconductors, while only 34.5% were net sellers. The institutions were actively accumulating the hardware foundation of AI.
That's a huge difference from the headlines.
Right. Even in the highly volatile data center sector, the buying and selling was a dead tie, 24.3% acquiring and 24.3% offloading.
So what does this all mean? It tells us that the capital isn't vaporizing or leaving the AI space, right? It's simply rotating within the ecosystem.
Exactly.
The big money is still funding the physical infrastructure build-out, but they are clearly changing their strategy. Which brings me to my next question. If Bridgewater still believes in the AI sector, why do they aggressively dump 92% of Micron while keeping NVIDIA? Like, where did that capital go?
To answer that, we have to follow the money. Bridgewater executed a massive pivot into broad American market index funds.
Okay.
Specifically, they bought heavily into S&P 500 ETFs. An ETF is an exchange-traded fund, a vehicle that allows you to buy a basket of stocks in one single trade. They increased their holdings in the SPY ETF by 21%, the IVV ETF by 12%, and the VOO ETF by a staggering 188%.
188%, that's massive.
Oh, and they are not alone in this strategy. Tudor Investment Corp, another massive heavyweight, increased their IVV holdings by an incredible 730%.
A 730% increase in a broad market index is a tectonic shift in strategy. Let me translate this into simple economic terms for an American beginner investor listening to us.
Sure, go for it.
Imagine you are standing at a horse racing track. For the entire last year, every single person in the stadium has been betting heavily on one specific, incredibly fast racehorse. Let's call that horse Single AI Company.
I like that.
But now, the billionaire investors are changing their approach. Instead of putting all their cash on that one horse, they are walking up to the counter and buying an ownership stake in the entire racetrack. By buying the S&P 500, they are spreading their bets across the 500 largest companies in America.
That's a great way to put it. And if we connect this to the bigger picture, the mechanical reason they are making this shift becomes obvious.
Which is?
The S&P 500 is fundamentally a market capitalization-weighted index. That means the biggest companies make up the largest percentage of the fund. Right now, the index is overwhelmingly dominated by Microsoft, Apple, NVIDIA, Amazon, and Alphabet. By purchasing the ETF, these hedge funds are still getting massive exposure to the AI boom, but they are drastically lowering what financial analysts call idiosyncratic risk.
Okay, let me push back on that logic for a second.
Sure.
If the S&P 500 is already heavily concentrated with those exact same tech giants, aren't these billionaires just buying the exact same AI risk, just disguised under a different ticker symbol? I mean, if NVIDIA and Apple crash, the S&P 500 is going to crash too, right?
That is a very fair critique, but the mechanism of an ETF provides a crucial layer of insulation. Idiosyncratic risk is the danger of a catastrophic failure specific to one single corporation.
Like a scandal or something.
Exactly. Let's say you hold $1 million of NVIDIA stock directly. If NVIDIA's CEO makes a fatal strategic error or a massive factory goes offline, your entire $1 million plummets.
That'll hurt.
But if you hold $1 million of an S&P 500 ETF, you still benefit if NVIDIA goes up. However, if NVIDIA faces a company-specific disaster, the other 499 companies in that basket, the banks, the healthcare conglomerates, the retail giants, they act as a shock absorber. Oh, I see. So Bridgewater is not hiding cash under a mattress. They are restructuring their portfolio to survive volatility while staying in the game.
Here's where it gets really interesting, though. While some funds, like Bridgewater, are buying the whole racetrack, other billionaire funds are looking at the exact same data and making wildly opposite bets on individual companies.
It's pretty wild.
Yeah, we are seeing legendary investors flat out disagree with each other on paper.
The contradictions in the recent 13F filings are truly historic. Let's look at Tiger Global. They dramatically slashed their position in Alphabet by 45.4% and cut Broadcom by 51%.
That's a huge cut.
But they didn't leave the sector.
Yeah.
They took that capital and more than doubled their stake in Intel while opening brand new positions in AMD and SpaceX.
And then you look at a fund like Third Point, managed by Daniel Loeb. The filings show they completely liquidated NVIDIA, and Broadcom just brought those positions down to absolute zero.
Completely out.
Yeah. But then they turned right around and deployed that cash into TSMC and Alphabet. So Tiger Global dumps Alphabet, and Third Point aggressively buys it. But the ultimate curveball comes from Warren Buffett's holding company, Berkshire Hathaway.
Yeah, Berkshire Hathaway serves as the ultimate counter-narrative to the idea that smart money hates tech right now.
Totally.
At the exact same time Tiger Global was dumping Alphabet, Berkshire Hathaway was quietly accumulating it. They increased their Alphabet holdings by 83%, building a massive $37.8 billion position.
$37.8 billion.
Yeah, Alphabet is now the third largest stock holding in Buffett's entire portfolio.
Yeah.
And this aggressive purchase actually snapped a 14-quarter streak where Berkshire had been a net seller of equities.
So Warren Buffett is essentially backing up a dump truck to load up on the exact same stock that Tiger Global is discarding. How is it possible that the smartest financial minds on Wall Street are looking at the same technological revolution and coming up with completely opposite answers?
Well, it signals a fundamental shift in the market's life cycle. The AI consensus has officially collapsed. Interesting.
Think back to last year. The consensus was incredibly simple and unified: AI is the future, so buy the hardware companies and the chip designers. It was the classic gold rush phase. Everyone agreed you should buy the companies manufacturing the pickaxes and the shovels.
Right. Just buy NVIDIA and chill.
Exactly. But today, the reality is much harder. Every institutional investor still believes AI will change the world. But nobody agrees on which specific corporation will actually extract the most profit from it over the next decade.
So the era of just throwing money at the AI trend is over, right? We are now in the era of buying the AI business model.
That is the perfect way to phrase it. Institutional investors are shifting their focus away from pure hype and staring obsessively at return on invested capital, or ROIC, alongside free cash flow.
Let's break down return on invested capital so the mechanism is crystal clear for you listening. Imagine you own a small independent coffee shop.
Okay, I'm with you. You decide to buy a state-of-the-art, hyper-advanced espresso machine for $20,000.
Yeah.
That machine makes incredible coffee. But now you are in a deep hole. You have to sell thousands and thousands of extra lattes just to pay off the initial cost of the machine before you see a single penny of actual profit.
Right.
Right now, American tech companies are buying billions of dollars worth of AI espresso machines, and the hedge funds are looking at the balance sheets and asking, are you actually selling enough AI software to justify this massive infrastructure cost?
That analogy hits the nail on the head. The data shows that global infrastructure spending on AI data centers is still accelerating, but Wall Street is fractured on who can actually monetize it.
They don't know who's going to sell the lattes.
Exactly. Berkshire clearly believes Alphabet has the software ecosystem and consumer reach to sell enough lattes to justify their server costs. Tiger Global might be looking at the domestic manufacturing landscape. perhaps anticipating future government incentives for American foundries and betting heavily on Intel's turnaround.
Makes sense.
And third point is betting on TSMC's absolute dominance in offshore manufacturing. The fact that they are taking opposite sides of the trade proves there is no obvious easy answer anymore.
Okay, so if I am an everyday retail investor listening to this, a very dangerous thought might cross my mind.
Yeah.
I might think, I don't have a team of analysts. I don't need to figure out who is going to win. I will just pull up Warren Buffett's 13F filing or Bridgewater's 13F, and I will just mimic their trades exactly. If a billionaire bought it on June 30th, I will buy it today. Explain the mechanism of why copycatting a 13F is a terrible strategy.
Oh man, it is one of the most reliable ways to destroy your own wealth. And the data from this recent quarter provides a chilling, real-world example of exactly why. We have to examine the brutal tech crash that occurred in July.
Yeah, that was rough.
There was a highly publicized fund called Situational Awareness run by Leopold Aschenbrenner. This fund was heavily concentrated in the AI and memory chip sector. According to the June data, a terrifying 56% of their entire portfolio was concentrated in just two specific stocks, SanDisk and Micron.
Wait, having 56% of your capital in just two stocks isn't investing. That's walking up to a roulette table in Las Vegas and putting all your chips on a single number.
It requires extreme conviction, that's for sure. Now, follow the timeline carefully. If you, a retail investor, looked at their June 30th 13F filing when it was legally published to the public in mid-August, you would see this massive, confident, multi-million-dollar bet on SanDisk and Micron.
So you'd think, hey, they know what they're doing, I'll buy in.
Right. But the 13F completely shields you from what happened in the 45 days in between. In July, the market violently shifted. Memory stocks plummeted. And because the Situational Awareness Fund was utilizing leverage, meaning they were trading with heavily borrowed money, they were hit with massive margin calls.
Let's clearly define a margin call. That is when the prime brokerage or the bank calls the fund manager and says, the stocks you used as collateral for your massive loan are dropping in value. You need to wire us millions of dollars in cash immediately to cover the difference, or we are going to forcefully sell your assets at whatever price we can get.
Exactly. And because the fund could not produce the cash to satisfy those margin calls, the bank stepped in. The fund was forced into a catastrophic liquidation, having to offload their public stocks to Citadel at highly unfavorable prices.
Ouch.
And the damage was contagious. Jane Street, a massive quantitative trading firm that had similar concentrated AI positions, reportedly took a staggering $15 billion hit during that same July volatility.
This is the trap. If an everyday investor looked at that June 30th filing when it became public in August, they would see supreme confidence in those two companies. If they blindly copied the trade, they would literally be buying shares that the original fund manager had already been forced to liquidate weeks prior.
You would be trading on the footprint of a ghost.
Oh.
By the time a retail investor sees a 13F, sophisticated algorithmic trading firms have already priced in the delayed data. You don't know the entry price the billionaire got, you don't know their target exit price, and you have no idea if they had complex derivative hedges in place to protect them from a crash.
Furthermore, based on the data, sometimes these massive institutions sell a stock for structural reasons that have absolutely nothing to do with the company's performance.
Right, the internal rules.
Yeah, many funds operate under strict internal risk management rules. Like, a fund might have a mandate that no single stock can exceed 5% of their total portfolio value. If they bought NVIDIA early and the stock price absolutely skyrocketed, suddenly NVIDIA might represent 8 or 9% of their portfolio. They are contractually forced to sell millions of dollars of NVIDIA stock just to rebalance and follow their own rules. They aren't selling because NVIDIA is a bad company. They're selling because of a math equation.
That is a fundamental reality of institutional finance. A 13F filing was never designed to be a buy list for the general public. It is a macroeconomic map showing how the tectonic plates of global capital are shifting. It highlights when institutions are worried about crowded trades, where too much money is crammed into the same three tech stocks, and it reveals how they manage their internal risk thresholds.
It's about reading the landscape, not blindly stepping in their footprints. So synthesizing everything we've covered, the AI exodus is a complete myth driven by a misunderstanding of how hedge funds operate.
Exactly.
The capital isn't leaving the ecosystem. The smartest money in the room is simply diversifying. They're transitioning from betting on individual racehorses to buying the entire racetrack, and they are placing incredibly calculated, opposing bets on which companies can actually turn the massive cost of AI infrastructure into sustainable long-term profit.
And looking forward, this data forces us to consider a much larger structural question about the physical reality of AI. Right now, companies like NVIDIA have infinite pricing power because we are in an era of extreme scarcity. Every tech giant is begging for more chips. But what happens when that scarcity ends?
When the supply chain finally catches up and every single data center has all the computing power it needs.
Precisely. Once the hardware shortage is resolved, the balance of power will shift violently. But there is a secondary layer to this that goes beyond just tech companies. We have to consider the geopolitical reality of where these physical chips are actually manufactured.
Oh, yeah.
The vast majority of the world's most advanced AI chips are produced offshore by TSMC in Taiwan.
And this is where macroeconomics meets global politics,
Right.
especially considering the current American political landscape. I mean, under the current Trump administration, there is an intense focus on domestic manufacturing, trade policies, and, adjusting international relationships.
That is the exact friction point. If the current administration decides to implement massive, sweeping tariffs on foreign technology components, or if the geopolitical tensions in the South China Sea disrupt the physical shipping lanes, the entire economic model of AI changes overnight.
Wow, literally overnight.
The billionaires aren't just calculating software profits. They are trying to predict how American trade policy and international tariffs will impact the physical supply chain over the next 4 years. A single policy shift could instantly make domestic foundries like Intel the most valuable assets on Earth, while devastating funds overexposed to offshore manufacturing.
The technology might be virtual, but the supply chain is deeply physical and incredibly fragile. It is such a fascinating transition period. The easy chapter of the AI story is officially closed, and the complex reality of global economics is just beginning. Don't forget to subscribe and hit that like button.